Coming off the first negative quarter for the financial stock markets in over 2 years, we find gas prices literally out of control. Bond treasury yields not only inverted and upside down, but now also somehow inside out. And this mortgage broker thinks the Federal Reserve should raise interest rates at least 1 to 2% in their next meeting in May. And when I tell you why, you probably won't think I'm crazy. And a good tip to my real estate agent friends, it's probably time to take the temperature of your buyers and sellers in this new interest rate environment. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. I sure hope you're having a great week. All right, first quarter is now over somehow. This year is flying by, as everybody I'm sure watching this feels. I'm going to do a little report card really quick here. Dow Jones down 7% from its all-time high. That's what I'm going to gauge this on, all-time highs, not year-to-date. Dow Jones down 7%. NASDAQ tech heavy, of course, down 14%. S&P 500 down 7%. Oil trading at around $100 a barrel. Who knows? This is the traders. The president last week came out and said that they're going to start putting out 1 million barrels a day. It'll take them a few months to get online. That brought oil barrel prices down, but when you go to the gas station, it did not bring gas prices down accordingly. So that's all traders, that's all speculation, and that's all fear and fluff, and I'll get to that, the prices at the pump. Gold essentially sitting at an all-time high. Which of course is a flight to safety and quality. Bitcoin, it's down 37% from its all-time high. Bitcoin still interesting to me. I don't understand how it trades, what it's tied to, but I know it's certainly one day going to become a hedge of a hedge for something. And the 10-year Treasury, we are sitting at a yield of 260 basis points, 2.6%. Give you an idea of how far and fast we've come. On March 4th of this year, we had a yield of 1.7, 170 basis points. We are up 90 basis points in the last month on the 10-year Treasury. And to put this in relation, for the majority of the time in the last few years, we were trading, the whole value of the 10-year Treasury was under 100 basis points. Now it's moved up 90 basis points, more than its value that it was trading at for some time in the last month. So this is the shock I've been describing, and it's very staticky right now, this shock. 10-year Treasury up 90 basis points in the last month. All right, so I talked about gas prices. They are indeed out of control. I don't think they're sustainable, and I think the consumer is just about at their breaking point with this. And the best part about the consumer is the consumer votes every single day. The consumer votes with their pocketbook every single day. And I think these gas prices are going to force the consumer to start taking electric cars more serious. And that's where the votes are going to go. The money, the dollar votes are going to go towards electric cars and probably solar energy on their homes, as natural gas is not cheap either right now. So hopefully we can have the government and the consumer working hand in hand. As the president said last week when he said he's going to bring 1 million barrels of oil online in the next year or whatever it is. He also talked about some infrastructure plans. I think that could be very positive in the long run. The government gets involved and helps with the infrastructure needed for a shift away from dirty energy onto clean energy, which in my opinion is well overdue. So we will see what happens. But gas prices all manipulated by traders. And again, these are the same traders that could not pay people $15 a barrel to store it overnight a couple years back, month of March of 2020. So we'll see what happens, but I think the consumer is going to win this, and the gas companies are going to end up losing. Bond yields, as I described, are not only upside down, inverted, but they're now inside out. On a day-to-day basis, it's hard to keep track of if the 2, 3, 7, 10, or 30-year Treasury, who's above who, but right now the 5-year Treasury, which actually sits right in the middle of that range, is a runaway train right now. It's yielding, I think, about 10 or 12 basis points higher than the 10-year Treasury. All that tells me is with all of those trading at the same level, then the 5-year sitting right in the middle of that range, people basically know rates are up, but they don't know on the long term if they're going to go up more or if in the short term they're going to come down more. So the yield curve is indeed technically flat right now, with the 5-year essentially runaway train coming out of that. This is obviously a classic indicator signal of a recession to come, unfortunately, in the economy, when you couple that with the high oil prices, or high gas prices, I should say, that we have right now. So you better believe the Federal Reserve is going to keep an eye on that. Now on to the Federal Reserve, who I'm going to start calling the boogeyman in the room. So a few weeks ago, I described how powerful the Federal Reserve is. The Federal Reserve doesn't actually have to raise interest rates for interest rates to go up. So our mortgage rates, for a lack of better, are up depending on program and type of property and whatnot. We're up anywhere from 1.5% to 2% off the lows that we were doing in the last few years. And the Federal Reserve has only raised 0.25%. And yet we've gone up 1.5% to 2%, depending on day and hedging, for that matter, by the traders on the bond side. So the Federal Reserve is the new boogeyman. They talked rates up for the second time in 2 weeks. First they raised rates, nothing happened, yields went down, they talked them back up. Then on Monday, apparently what they did last week wasn't good enough. They literally trotted out in front of the cameras, or had her make a statement, the most dovish Fed governor out there, and she said, reiterated, they are not scared to raise interest rates. Well, at this point, let's just rip the Band-Aid off. We all know they're going to go about 2 to 2.5% this year. They've only gone 1/4 so far. Here's my idea. I would actually implore them, and I'll tell you why I'm imploring them. It's for their own good. I would actually implore them to raise rates 1 to 2%, and it wouldn't hurt my feelings, and I'll tell you why. It's already built into the mortgage market. We are already there. We are living in the future that they have told us what the future is going to look like with their Fed funds overnight prime rate. Mortgages have moved up. So at this point, if the Federal Reserve just gets all of these upcoming half point, quarter point, whatever point hikes they're going to do, I think they should just rip the Band-Aid off. Take it off. Let's just raise 2%. Let's just get there. And at least then, and this is why I implore them, they have their tools back in their toolbox. Meaning, the first tool they have is the ability to cut rates, and they can't wait to raise them, so when they need to, they can cut them. I'm not telling them anything they don't know between oil prices and inverted yields, what that's done historically. They know there's a recession coming, and I think in order to get us out of this recession that's coming, however deep it may be, that is yet to be determined, but it is coming, they're going to need to cut interest rates to do that. And the only way they can cut them is by raising them. And the only way they can cut them quick is to raise them even quicker. So, Federal Reserve, please, 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 begging you, raise rates 2%. Let's rip the Band-Aid off. Let's get this over with, and let's move on with our lives already, rather than us trying to figure out if you're going to raise 1/4 or 1/2. And I think you actually set us up for that yesterday, more so than ever, by trotting out the most dovish Federal Reserve governor and having her say that you're not scared to raise rates. So my guess is that was a signal. They're going to go more than 1/2. I would actually like them to go to 1.5 or 2 and just get it over with. Because at least then, when the economy gets bad in their eyes, they can start cutting again. And then there's another thing here. There is fluff in this market, the mortgage market, in my humble opinion. There's about 0.5% of fear built into these rates. And I think that fear is actually translating over to the gas pump with the oil traders. Fear is probably putting a 20% premium, my guess, maybe 25 in this oil market, on the price of gas. And obviously this is all pure speculation. But I'd like the Federal Reserve to raise 2% in their meeting in May. And for my real estate agent friends, it has indeed been insane last 30 days in the mortgage business, which obviously is the real estate business to some degree for your non-cash buyers. As an agent right now, you should be taking your client's temperature, whether they're a buyer or a seller. Now, the buyers, you should hear the conversations I'm having with people just this week on the rate change from Monday to Wednesday, and certainly the shock that has set in from, if I haven't talked to somebody that much since the end of January, beginning of February, they got out of the market, now they're back, they've picked up the phone, they started calling me and their realtor again, and they are just in shock to the point of swear words coming out of their mouth on what happened to these mortgage rates. So as a real estate agent, you do need to be taking the temperature of your buyers if you're going to go out with them again here. And certainly with your sellers, you know what their temperature is, but you have to explain to them what the temperature of the new buyer mentality is for them to line up with the expectations that you've certainly set with them when trying to sell their house. So it's time for the real estate agents to pick up the phone and just take the temperature of everybody, buyer, seller, everything else. Because I will tell you this, pre-conversation with the mortgage broker, they have one mentality. Post-conversation with the mortgage broker, they certainly have another. So in order to keep things cool, calm, and collected when making offers and taking offers, take everybody's temperature. All right, everybody, that is my show for this week. Thank you so much for watching. If you have any questions about your mortgage or anything real estate related, as always, please don't hesitate to reach out to me. Have a great rest of the week. Thanks again.